Hello and welcome to our discussion on financial accounting. In this session we will try to understand by taking examples about the business decisions and converting those business decisions into financial statements. We know that every business decision will affect the financial statements through financial items. So every business decision will involve financial items, and these financial items appear in the financial statements. So the business decisions are the transactions for a particular year, and in this case we are taking the transaction of an hypothetical textile retail company, and the transactions are for the year 2013-14. So we are taking an accounting period for 1 year. So the financial statements are for a period of 1 year. Balance sheet is as on 31st March 2014. The income statement is for the period 2013-14, and cash flow statement is for 13-14. So these are the financial statements of the company or this retail company. When we are starting the business, the company is getting cash. So therefore it is a receipt for the company, and the receipt is 300,000. But this receipt is not an income but capital. So in the sources side, the capital will appear on the balance sheet. The company raised 9% bonds on 1st April. So this is again a receipt for the company, and the company received 200,000. And this receipt is also not an income but a liability. So we can see that the company has received 500,000, and part of the 500,000 is the capital and a part is the liability. Purchase t-shirts for cash, so it's a payment of stock of goods. Because it's a retail company, this is a revenue goods for the company, and we call this stock, and TS represents the t-shirts. The amount of the stock acquired is 240,000, and acquisition of asset, this payment resulted in acquisition of asset. So therefore 240,000 will be an asset appearing on the balance sheet. Purchase laptops on credit. So the acquisition of laptop, unlike the t-shirt, did not result in the payment but has resulted in creation of a liability. So acquisition of laptop resulted in creation of a liability called X for laptop, and the amount is 90,000. So if you see these two acquisitions, one acquisition has resulted in creation of liability, other acquisition has created in the reduction of cash flows, that is payment. Sold 60% of t-shirts for cash. This is the main business of the company, so this is an income. So income, in this case we call it sales, and the sales amount is 300,000, and 300,000 is the income for the company, and this income has been received during the period. So income has been received during the period, and income has been received 300,000. And by using the matching principle, whenever there is a sale, there has to be cost of goods sold, and 60% of the stock available has been sold. So 60% of the stock converted to expense. As a result, the stock will reduce to the extent of that 144,000. Let us see this 96,000 once again. There was a stock of 240,000. There is a stock of 96,000. So 144,000 stock has become an expense. Stock is an asset, whereas COGS is an expense. Expense is what? The benefit expired. An asset is, stock is still an asset because the benefit is unexpired. Purchase shares 100,000. Let us assume it for cash. So purchased shares is an acquisition of asset resulting in the cash outflow. So acquisition of asset resulting in cash outflow. Salary paid. Salary is a payment and salary is an expense. So this payment resulted in an expense, and the amount of expense is 30,000. So is the case with the rent. Rent 60 is 50,000. Rent is a payment and rent is an expense here. Rent is an expense, 50,000. Advance rent is an asset. Advance salary is an asset, but salary for the period is an expense. Commission. Okay, so commission for the period is 5% on sales, and 5% on sales we treat that as an expense. 5% on sales is 15,000, and that is an expense and a payment. That is 15,000. The next session we'll see if the expense is not paid. Interest is a payment and an expense. So interest for the period is 1 year. So therefore interest is 18,000. You can see that because our accounting period is 1 year, we calculated interest on 200,000, 9% for the year, and interest is an expense. So 18,000 is an expense. Purchase stock and issued shares. So our stock is 96,000 and we purchase stock of 50,000. But the stock has increased. But this increase in the stock to the extent of 50,000 has not resulted in the payment, neither resulted in any creation of a liability, but has resulted in increase in the capital because the shares have been issued. So acquisition of asset like laptop has created a liability. Acquisition of shares has resulted in reduction in cash, but acquisition of stock has resulted in increase in the capital. So if all transactions have been entered or recorded or converted, shown in the financial statement, now we have to find profit, for the time being ignoring taxation. So profit is equal to income minus expense. 43,000 is the profit. And whenever there is a profit, the management has to take a decision what to do with this profit. The option available is to distribute or retain. Let us assume for the time being that we are retaining the profit, so entire profit becomes a source. Profit is excess of income over the expenses, and this profit can be retained or distributed, and in this case we are not distributing but retaining the entire profit for the period. So retained profit is a source. Now let us find the cash in hand. Cash in hand is cash available minus the cash payments. So cash in hand is equal to cash available minus cash available minus the cash payments, and cash available is cash in hand is equal to 347,000, and cash in hand is an asset. So I transfer the cash to the balance sheet, that is cash in hand. So we can see that the profit comes from the income statement, cash from the cash flow statement. This clearly shows that the balance sheet depends on the income statement and cash flow. In other words, income statement and cash flow are the important components of the balance sheet because they give you idea about the profit and the cash in hand. So the sources are equal to assets, and these sources can be put as the accounting equation that assets is equal to liabilities plus equity. So balance sheet is representation of accounting equation on a particular date. On this date, the number of shares that the company is having is a capital divided by the face value, and here we have assumed the face value to be 10, so therefore number of shares is equal to 35,000. So by using these two numbers, we get one of the important financial accounting numbers, that is called equity per share, which is popularly known as the book value per share, is also called the book value per share. So book value per share is the equity by number of shares. So if a set of transactions are given or business decisions are given, it is possible and necessary to convert those decisions into financial statements. These decisions cannot be seen by the shareholders. Managements take this decision, but the management is under obligation to share with the shareholders about the implications of these transactions, and that is the financial statement. So financial accounting is a process of converting these decisions into financial statements. However, there is something intermediary step. That intermediary step is the accounting equation. All these transactions, after every transaction, the S will be equal to A. So every transaction affects the source and application in such a way that S will be equal to A. At any point of time, you can represent this equation in the form of a balance sheet. For example, in this case, after the last transaction, we can show this equation in the form of a statement called balance sheet. So it is possible to prepare the balance sheet by just using the accounting equation mode. However, it is advisable to do that along with other financial statements. For example, in this case, we know exactly why and how the profit has been determined. Here we are not able to show that. How did we get 43,000? In the same way, here we know exactly what are the total receipts during the period, total payments during the period, so the cash in hand, total incomes during the period, total expenses during the period, so there is a profit. So such an explicit information, such clear information is not available in the accounting equation. So accounting equation is also not a mandatory financial statement. So no companies show the accounting equation, but the financial statements are, every company is required to prepare the financial statement periodically and share with the shareholders and other stakeholders. Thank you.